So we're basically buying and selling, and we don't often think about who's on the other side of our trade. In many markets, we do have high-frequency trading. And the high-frequency traders are simply providing liquidity. A lot of people tend to view hedge funds, high-frequency traders, in a negative light. The high-frequency trader is simply providing liquidity. We need somebody to provide liquidity. And then it's possible to become paralyzed with that fear of being wrong. I don't want to be wrong, so if I'm buying, why isn't everyone else buying? Well, maybe people are selling just for various other reasons. They could have a 5-year time frame, you could have a 5-minute time frame. They may believe something different about the stock. They could just be randomly buying and selling. I know when I'm doing buying and selling, it's based upon just the technical strategy, and I don't even really know what the company is when I make the decision to buy or sell. So I have no idea who's on the other side of the trade. They could be a long-term value investor. They could have a completely different opinion. My opinion is based solely on the chart pattern that I see. So later, after I make the decision, I look up what the company does. But that's not even factoring in at first. So you have to decide where you fit on the spectrum and where you're comfortable, and know your role in the market, because we do have a tendency, especially among individual investors, who worry about taxes. And a lot of individuals do make bad decisions based on tax planning. Probably the best tax strategy is make as much money as possible and pay what you owe in taxes. If anybody's ever managed money for individual investors, try selling that. The individual will argue they don't want to pay taxes. They'd rather ride a loss back down than pay taxes. And as an individual, taxes are kind of your badge of honor. The more you pay, the more you make. And taxes are the only place where we avoid making money. So, something to keep in mind. Would you rather be right or would you rather make money? Really is a question. When it comes to technical analysis in particular, there was the guy who ran the technical analysis department at Merrill Lynch for many years liked to ask his analysts what they were providing that no one else was providing. The idea boils down to, if you know what everyone else knows, you don't know anything. And in the markets, that makes a lot of sense. So this was a more recent study that was done. In China, there's multiple dialects, and the authors looked at analyst reports written in different dialects. And what they found is that the dialect made a difference in the impact of the report, with the least known dialects being more important information. So that makes sense. If everybody knows that information, you can't possibly make money on it. Apple is covered by 40-some different analysts. Can anybody really gain an edge on those 40 analysts? So with Apple, you're not going to find out something about their earnings that those analysts don't know. You need your own edge. You need something that no one else knows. So for technical analysis, if you go to a website, you see certain pre-made indicators available. You see RSI, you see MACD, stochastics. Everybody knows that information. You can't possibly make money trading off of the indicators that everyone else is looking at. And that makes sense. Yet, people do. People try to trade the indicators exactly like the defaults on stockcharts.com and other free sites. That's a very popular strategy among individual investors, is to use free information and then wonder why they lost money. So we're going to talk about, in some cases, those indicators work. RSI is my favorite example, the Relative Strength Index, one of the most popular technical indicators available. It was developed in the 1970s, and the guy who developed it wrote a book about it. He uses 14 days in the calculation for RSI. And in the book, he explains that he used 14 days because that's half the number of days between full moons. Okay, that's why you're using the indicator. When you know that, are you still going to use a 14-period value for RSI? That makes no sense. And we'll look at RSI in detail, but you just have to know something that is not available to the general public. The truth is, most traders already know how to win. The key is going to be consistency and discipline. And the Turtle Traders is a famous story. It's the movie Trading Places, where the question is, can traders be trained to win, or are you born with it? And what they found was you can be taught to trade. We're going to look at the turtle strategy in detail, but it's basically, if prices are going up, buy, and if prices are going down, sell. That's it. That's the whole strategy in a nutshell. The rules are a little bit more specific. At a new 50 to 55-day high, buy, and at a 20-day low, sell. If you do that, every time you see the pattern, you win. And when you think about it, that doesn't really seem that hard. If prices are going up, you want to buy. Defining when prices are going up is the key. So you want to do it consistently. And then you want to do it with discipline. You want to take every signal that comes up. That's all it takes to be a winning trader. So we're going to cover the idea, obviously, in more detail. But just by looking at that story, the guy who said all you need is consistency and discipline took $5,000 and turned it into $100 million. He did it in the futures markets in the 1980s. The advantage of the futures market in the 1980s was there were not a lot of traders. New markets present great opportunities for technical analysis. So if you look at a chart of Bitcoin, what you'll see is beautiful technicals on it. You could trade Bitcoin. Bitcoin is not buy and hold. The signals work on Bitcoin because nobody knows how to trade Bitcoin. In the futures market in the 80s, in the options markets in the 70s, simple technical indicators work well. So whenever you see a new market, you have the opportunity to trade it. And that is, the turtles all turn small dollar amounts into large dollar amounts. $5,000 to $100 million can't be done in all likelihood today, but you can take small amounts and do reasonably well with them. So what they did in that experiment is placed an ad in the Wall Street Journal saying, we're looking for traders. And hundreds of people applied, and they picked 14, and then they funded them. It only took 2 weeks for the training, and they taught them when to buy, when to sell, how much to buy. In the ad, they included some questions, and these were examples of the questions that they asked, which is basically, number one here, true or false, do you need to buy the low in order to make money? And a lot of people would say true, you want to buy after a big decline. The answer from the turtle's perspective was no. Let prices change. Don't try to catch the falling knife. Wait for the uptrend. The idea of watching the market constantly in real time is a very popular pastime. And a lot of people will put a trade on and then just watch every quote come in. Maybe that can be useful if you do it with discipline and know when you're going to sell and you're just watching it for entertainment. Most people get very nervous watching every quote. You shouldn't do that because you're just going to get too nervous. Other people's opinions of the markets are good to follow was one of the questions. They were looking for the answer, false. You want to trade your own strategy. If somebody just gives you a strategy to trade, you're probably not going to do well with it. I know a trader who does weekend courses. People pay him $10,000, and over the course of a weekend, he gives them a book with his trading strategies. He's been trading over 50 years. The strategies work. He says 90% of the people never even look at the book after they leave. The other 10%, 90% of them make a change to it. And then a year later, they send him an email. You don't know what you're talking about. Your stuff doesn't work. The few people who actually follow it do well because it's a strategy. It's not an opinion. But if you don't believe in your own opinion, you're not going to make money. So you have to decide how you're going to trade. A problem with that is a lot of us have strong opinions. We're bullish or bearish right now. If we say, do you think interest rates are going down? Almost everybody says no. Interest rates are at 5,000-year lows. They can't possibly go lower. It doesn't matter what your opinion is. If you get a signal, you need to trade it. And that can be hard for a lot of people to do. So even your opinion isn't good to follow. Your strategy is what you want to follow. Risk management, we're going to talk about. This is not the right answer. Do not risk a predetermined amount of money on each trade. This is a very popular strategy. A lot of individual investors will set a stop loss when they open a position. They'll buy and they'll say, if I lose 3%, I'm out of it. The market doesn't care about your 3%. So that's really not a good rule. You need to have a stop strategy, an exit strategy that's consistent with the market. And this one can't be stressed enough. You need to know when you're going to sell before you open the trade. So if you don't have a strategy to close your position, you're going to end up panicking and closing at the wrong time. So here was the answers to that one. You'll have them. You guys all get a copy of the slides. Says you want to share the test results with others. You can see how you fared. So the turtles were able to deliver average annual results of 80% a year. And I think in the stock market, we take this limited perspective of returns. A lot of stock market investors think 7 to 10% a year is a good return. And you can't do more than that in the long run. But you can. You just need to use a short-term strategy. When stock market investors think about stocks, they'll talk about the long run. They'll look at 100 years of data and say, look, stocks return 7 to 10% a year. But if you compound growth, that adds up to a lot of money. They're right about compounding. The goal of the turtles was to compound wealth several times a year. A lot of people will look at compounding in terms of a year, and if you compound 10% a year, you double your money every 7 years. But what if you made 10% a month? Then you could compound and double your money in 7 months. So what the turtles did was they shortened that time frame. Most investors think in a 1-year time frame because that's what our bonuses are based on. Thinking in a 1-year time frame isn't going to get you these kind of returns, which really are possible.